Okay. Hi, everyone. Thank you for joining FAM for this another webinar called Grow Your Net Worth. And we have two amazing speakers from Wealthsimple we're so excited to have them join us today. And they're just going to take us through this amazing workshop. And I hope you guys get as much as I think you're going to get out of it. And just to give you what's going on here? Oh, I love, yeah. Just to give you a brief intro for the speakers, we have Sadia Khan and Hasan joining us today. And Sadia is a client experience associate at Wealthsimple who's very passionate about empowering others to reach their financial goals. And Shaz is a portfolio manager at Wealthsimple, and she's very focused on making financial freedom more accessible to everyone. And I would say it's safe to say that both of them are very passionate about closing the gender wealth gap. And so they lead a lot of workshops that focus on educating women on their financial well-being. So I'll pass it on to Shaz and Sadia to continue. So let me just stop sharing.
Perfect. Thanks so much, Tomi. Thank you so much for hosting us as well. I'll just share my screen to get the presentation started. Awesome. Can everyone see my screen? Awesome. Okay. Perfect. Well, welcome everyone, and thank you so much for joining us today. My name is Scherezade, like Tomi mentioned. My colleague and I here from Wealthsimple, and really we're here to chat about how to grow your net worth. It'll be a casual conversation, and we'll leave 15 minutes at the end for questions. But if you do have any questions, just feel free to throw them out on the Zoom chat. But yeah, I'll let my colleague introduce herself.
Everyone, thank you for joining us today. My name is Sadia, and I work on the client experience team here at Wealthsimple. It's been about 1.5 years since I've been with the company, and coming from a big bank, it was very much a cultural difference to be working at Wealthsimple, but I've been very passionate about the company even before I started here, and so far it's been a great ride.
Awesome. A little bit more about Wealthsimple if you're not already familiar with us. We're an online investment management platform, and we aim to make smart investing easy, low cost, and transparent. Our goal really is to make financial freedom accessible to everyone, regardless of age and net worth. So far, we host 150,000 clients on our platform and expanding over 3 countries, so Canada, US, and UK, and we're managing over $5 billion in assets.
Awesome. So the 3 things that we'll be touching upon over the course of today would be starting off with money mindset and the gender investment gap. Then we'll touch upon financial planning and then talk a little bit about investing 101. Like Shez was mentioning, it's going to be a super casual conversation. So at any point, if any of you guys have any questions, feel free to use the Zoom chat feature and we'll hop on in there and answer them as we go along. Feel free to interrupt us at any point as well. Let's get started with money mindset. So the topic of money tends to be a very emotional one for a lot of people. It's very personal and everyone has a different relationship with money. How you relate to money affects your behavior, and good financial behavior ultimately means more money in your pocket. Excuse me. And studies show that investors tend to underperform their investments by 1.5% on average because of bad behavior alone. And the best thing we can really do is just openly start talking about money. The more we talk about something, the more ideas we get, the more we understand it. And money is really just a tool within our tool belt that we can use to help build stability in our lives, as well as capture new opportunities. Much like any tool, we need to learn how to use it. So essentially, in short, money mindset is just having money in the forefront of our minds when we're having any conversation, and just not feeling that shame or that guilt around talking about it, because it's not something that should be shameful or you should feel guilt about. It is very normal. It is a large part of our lives and always will be. So we can start the conversation off about money with this group, specifically about chatting about the gender investment gap. So what is the gender investment gap? Before we can answer this question, I do want to take a second to make sure that we're all on the same page about what's the difference between investing and saving. And this is a great example which we can use to kind of illustrate that difference. So if you take a look here, Shez and Sadia both put away $5,000 over the last 35 years. By retirement, you can see that Sadia only has $157,000, whereas Shez, who decided to invest, clearly the smarter one, has about $450,000. This is a pretty stark difference. Part of this difference is due to the fact that investing your money in the market allows you to have a higher growth potential than putting your money aside and simply a savings account and earning interest. The second part of this difference is due to compounding returns, which is essentially your money making money. An easy way to think about this is, let's say you take a snowball, put it up at the top of the hill, and as you roll it down, it just gets bigger and bigger because it keeps accumulating snow as it goes down, which is kind of the same way you can think about compounding. Whereas if you look at a savings account or savings in general, you don't necessarily capture any of the growth that's occurring in the markets, and you also earn very little interest. So there is a very big difference, even if you put aside the same exact amount of money for the same exact time period, the investor will be better off in the long run. So now that we kind of have a basic understanding, I just want to ask, does anyone have any questions so far? Is everyone kind of comfortable with the idea of saving versus investing? We'll definitely touch upon this a bit more as we go along. But just going to pause here for about 5 seconds to see if anyone has questions. Okay, so kind of reverting back to the question about the gender investment gap. As women, most of us already statistically know that we make less money than our male counterparts. We also take more breaks in our careers by being caregivers if we choose to become one. And we also actually live longer than men by 7 years on average. So taking all of these things into consideration, we really need to make our money work for us. It is crucial that we invest. A recent study shows that women actually tend to keep 71% of their money in cash. And this is in contrast to men, which only 60% of men keep their money in cash. However, the percent of women that actually do invest, they make better returns than their male counterparts. So that's actually very interesting. So even though less women invest, the ones that do invest better than their male counterparts. A study in 2016 showed that the female investor did better by their male in comparison to their male counterpart by about 1.2% a year. They found that women who were investing were more likely to be risk aware, more pragmatic, and just had better long-term strategies, and thus in the long run experienced higher returns. If you look at women in households, they actually reduce the entire family's risk appetite by a healthy amount. They have more patience to actually weather out market downturns, and they panic less than men. So in short, women actually make very good investors. So I guess the question now becomes, well, if women are good investors, why don't more women invest? And that is largely due to fear. There was a study done where they took 2,000 millennial women, like you and I, and the number one reason why more women did not invest, actually 56% of those 2,000 said that fear was their main reason why they weren't investing. Women tend to actually spend a lot of time doing research and gathering things from the internet, trying to figure out what works, but we fail to actually take the plunge. And much like anything that's surrounded by fear, the best thing we can do in order to overcome this fear is have a plan. When we have a structured plan, we can stick to it, and then we can actually execute and get to the plunge part where we're actually taking action and investing. Which kind of brings me to the next topic of financial planning. So before I dive in, I do want to see so far again, if anyone has any questions, feel free to put it in the chat. Overall, financial planning aims to accomplish three things. One, it takes into account where you are now and where you want to be at a certain time. It uses the available tools that you already have and allows you to use it to your advantage. And the last part is it gives every part of your cash flow a certain task to do. So we're going to take a few seconds here to watch this pretty cool video about financial planning, and I'll go through a few steps on how to structure or how to build a financial plan. I would suggest, if you can't hear, we're going to turn on closed captions as well, so just follow along through that and turn up your volumes if needed.
First, you need a financial fitness check. We like to
I think we need
a super classy champagne waterfall. Classy. I just killed a kitten. Just kidding. Just seeing if you were paying attention. Not a murderer. We know exactly where you are. Not in a shady, we're spying on you through your webcam kind of way. Just that after learning some of the basics, we know you're ready to start investing and see those returns, which is exactly how you should be thinking at this point. But first, you need a financial fitness check. We like to think of it as a super classy champagne waterfall, like the kind you might find at the birthday of a reality TV star. Only instead of carbonated grape juice, it's your money that's flowing. And if you set up the glasses in the right way, it will set you on the path to being extremely smart and financially sound. If you have debts with an interest rate above 5%, like on a credit card, you absolutely must pay those off before you do anything else. Why? Well, credit cards charge a lot of interest, as much as 18% or more. Because you'll be paying more in interest than you'd make on pretty much any investment, you'll be losing money by not paying down your debt. We should all be ready in case something unexpected happens. An illness, a layoff, a terrible decision to buy the world's most expensive dinosaur bones from Nicolas Cage. Otherwise, you're gonna have to go into debt to support yourself before you're back on your feet, and then you'll have to start the waterfall all over again. So it's smart to set aside 3 to 6 months of expenses. We recommend 3 months for singles, 6 for families, and to keep it somewhere low risk, like a savings account. You're probably thinking, didn't they just spend 15 minutes telling me I should invest? But think of this as a safety net for your financial future. Congratulations, you're now high interest, debt-free, and you have your emergency fund. Now let's get you some free money. Because that's what an employer matches. If your company gives you extra money when you contribute to your retirement account, called matching, and you're not taking advantage, you're essentially turning down part of your salary. Don't do that. Get that money. The government. They want us to save for retirement because then, when we get old, we won't become expensive problems for them and society. And the big incentive they offer to do that is these tax-advantaged retirement accounts. Money in these accounts, sometimes called a TFSA, a tax-free savings account, or RRSP, they all grow tax-free. Now the champagne's really flowing. You got 4 glasses full. There's no more high interest debt holding you back. You and your family are secured with an emergency fund in place. Free money from your boss is coming in. Tax-free accounts are up and running. The next best thing to do with extra cash may be to pay down other debts, even those with an interest rate of less than 5%, like mortgages, student loans, car loans. Why? Well, these low interest debts still have some interest, which means they could be eating into any financial gains you make through saving and investing. Now let us pop some bottles. Because if you've made it to Glass 6, you definitely deserve a toast. Seriously, making the most of employer and government retirement programs and paying off all your debt, it's a huge achievement to celebrate. But even better than a chorus of Mazel Tovs, it's that it's time to make some decisions. So one option you have is to invest in a personal account, an investment account that gets taxed. You could also choose to max out your retirement accounts. Another option is to consider putting money toward larger savings goals, whether it be a new car, house, or graduate school for your 9 children. Maybe that's too many children, in which case you should really have RESP accounts. Remember, if you have money that you intend to spend on a big purchase, house, wedding, college, within the next few years, it should go in a savings account. Any investment folks who guarantee you gains in the short term are people to be suspicious of. But you know that. After 6 full glasses of financial health, you're expert level now. Chin chin.
Awesome. Yeah, so there's just a quick recap here of the 6 steps. I won't go through them, but we'll also send along the video afterwards as well if anyone wants to take a look at that again. But kind of moving on to the next slide. As you plan or continue to plan for your financial future, you'll want to know how to structure your finances in order to ensure that you're actually hitting your financial goals. At Wealthsimple, we love to use rules of thumbs. A great rule of thumb, an easy one, is the 50-30-20 rule. It basically says that 50% of your after-tax income should go into your needs, and these are typically reoccurring expenses. These are things that you cannot change, such as rent, car payments, bills, etc. And then the next 30% can be allocated towards wants. And these are anything that adds value to your life, that brings you pleasure and joy. And then the last 20% should be allocated towards savings. To ensure that the 20% is actually being allocated towards savings and your savings goals are being met, we do encourage everyone to set up auto deposits for these amounts. So having auto deposits set up for both your 20% saving goals as well as paying off the 50% of fixed expenses with auto deposits will really ensure that anything that's left over, which is only the 30%, is what you're using towards your wants. It's a very structured way to make sure that you're sticking to your financial plan and actually creating a better financial future for yourself. At Wealthsimple, we do have a pretty nifty tool that anyone can use. It's available to the public. Shez is just going to take a second to pull that up and show you what that looks like.
Awesome. So if you do know that one of your goals is to save up for retirement and your question really is how much to put aside, this tool can be really helpful. For example, if, let's say, you are 30 years old, let's say you're making 80,000. Right now you've got 10,000 in savings, and around half of your savings are already in a tax sheltered account. If you're not sure what a TFSA or RSP is, we will go into that shortly. And then the next step would be to say, how old do you plan to be when you retire? Most people retire at 65 years old. And how much you expect to spend is a rule of thumb is that your expenses in retirement would generally be around 70% of your current income. So that's the assumption made here. And then how much you actually plan to save per month. So you'll notice that by saving up $1,000, we're on track. We're rather on our way to our goal, but we're still pretty short. We're short by $771,000. And the tool also tells you how much more to contribute by to get closer to your goal of being in retirement and withdrawing $56,000 from your account every year. So as we increase this number, you'll notice that we're getting closer and closer to our goal. And if we save around $1,650 every month, which is 25% of our income, we are on track to get exactly what we need to retire. So we'll share this link as well after the presentation. So if you guys want to play around based on your specific situation, this can be really, really helpful to help you understand how much to put aside. Awesome. Let me just bring this back up. Okay, so like we mentioned, there are a couple different kinds of accounts that that you can use to help you save up for your various goals. A couple of ones that you'll hear kind of being thrown around a lot are, you know, RSP, TFSA, and then the taxable personal account. So this chart has a lot of stuff going on, but we'll go through it step by step, starting with the RSP. Any money that you put into the RSP is pre-tax. What that means is that the money that you put in the RSP hasn't been taxed yet, or the amount that you put in the RSP can be deducted from your income. So that year, you're essentially taxed as if your income was that much lower. So for example, let's say you're making $100,000, and for simplicity's sake, your tax rate is 20%. So you'd be responsible for paying $20,000 worth of your salary in taxes. But let's say you decide to contribute $20,000 to your RSP account. Now the CRA looks at your income as if you've received $80,000 this year, not $100,000. And now let's say that because you're in a lower tax bracket, your income's lower, your tax rate at this level of income is now also 15% lower than 20%. So now you're responsible for paying $12,000 in taxes. If your income is taxed before you receive it, you're actually going to get a nice big refund of $8,000 after you file your taxes in this situation. When you take your money out of an RSP, though, that money is added back onto your income. So you're taxed on that amount. So if I withdraw that $20,000 this year, then I'm right back at having $100,000 of income, and I'll be taxed appropriately. So you would want to avoid withdrawing from the RSP where you can, but the RSP is really useful when you withdraw in retirement. When your income, and therefore your marginal income tax rate, is lower. So in retirement, if let's say I am making $70,000 as opposed to $100,000, I'm going to be taxed at that lower rate of, let's say, 15% when I take that money out in retirement. So I'm deferring my taxation and making savings that way. You're also able to withdraw from the RSP tax-free if it's for education or a first-time home purchase. And there are a couple of provisions there. So if anyone has questions on that, I'm definitely happy to talk about that more later. For the TFSA now, what goes in there has actually already been taxed. So basically the deposits that you put in there cannot be deducted from your income. But what's great here is that you're not actually taxed when the money comes out of the account. So you can withdraw it at any time. And it really offers you more flexibility. So you're not kind of forced to take this money out in retirement. If you have more, you know, short-term goals like house renovations or anything else, you can withdraw the funds from the TFSA, but in the meanwhile, invest them tax-free. One really important thing to note with both these accounts, though, is that you are limited to how much you can contribute to them. So once you've maxed out your contribution limits in these tax-advantaged accounts, you can move on to using the personal account. There are no tax benefits here, so you're taxed on the dividends, interest, and any capital gains that you make. Many people wonder which one they should use, what's more appropriate in their situation, RSP, TFSA, or maybe something taxable. Definitely, we would recommend that if you've got room in your tax sheltered accounts, start with those. But a simple rule of thumb that you can also remember when deciding between the tax sheltered accounts, the RSP and the TFSA, is whether your income is above or below $50,000. Generally, if your income is below $50,000, TFSAs are a better option. And that's because it's likely that your income in retirement might be the same or higher. So you're not really benefiting from deferring your taxes if you're paying the same now and in the future. Awesome. So kind of bringing it back to investing. Investing is a crucial way in which you can build your net worth. Like Sadia mentioned earlier, investing is like giving your money a job. You're able to take advantage of those compounding returns. So your money, you're making money on the money you make. Thinking about that snowball again. So when you decide to start investing, it's really important to understand the concept of risk. When you invest your money in a stock, bond, or ETF, the value of your money can fluctuate. So what this means is if I put in $100, it could grow to 110, but it could just as easily go down to $90. What makes a risky portfolio risky is having a larger allocation to stocks. Stock returns are volatile, which basically means that stock prices can go up and down and fluctuate greatly. And volatility and risk go hand in hand. But the real risk only comes in when you withdraw your funds at a loss. So we want to make sure that we're setting up your portfolio with the right risk based on how long you have till you need to withdraw this money. In the short term, market performance is a little more unpredictable, but in the long term, it is guaranteed to go up. So to kind of help you understand this, let's take a look at the S&P 500. Essentially just gives you a snapshot of how US stocks have performed in the past. So as we can see, the S&P 500 essentially is made up of shares of the largest 500 companies in the US. So it's a good indicator of how the US market's doing. So I mean, if we look at one day, these prices are fluctuating quite a lot. And it's pretty much the same when you're looking over a month and 6 months. As you look over a year, the performance starts to get a little bit smoother. But when you look at 5 years, you can see that it's an upwards trajectory. And when you look at all time, you can see a really clear pattern that although the prices move up and down, that the markets in general have been improving over time. So when you are deciding how to invest your funds, you should really look at your time horizon, your goals, and your own comfort with taking on risk. So let's say you want to take a vacation within the next 3 years. Statistically, this is too short of a time frame to invest your money. So we saw that short-term volatility when we looked within a year. Prices were up, prices were down. It was really hard to predict whether or not we would actually see any returns in the market. So due to that short-term volatility, you're at risk of having to withdraw your funds at a loss if markets go down in 1 year when you need them. Or if markets go down, you might have to push your goal back until your account is recovered. So instead of taking the vacation this year, maybe you have to wait till next year, the year after, whenever you do see those funds recover. But if you are looking to buy a home after 5 years, for example, so you can take on a little bit more risk. You have more time to weather the ups and downs that'll happen in the market and in the economy. So, but for your goals that are 10, 20, 30 years away, like retirement, your chances of recovery and significant growth are that much better. Besides your time frame, another factor in considering how much risk to take is your own comfort level. You don't need to be in an aggressively high risk portfolio because your best friend is. You don't have to be in an high-risk portfolio because you're only 20 years old or only 30 years old and you're young and you can afford to take risk. If you're not okay seeing your portfolio decline, seeing those huge fluctuations, it's okay to be in something that's more medium risk. Because really you're still putting your money to work, but you're being realistic about your ability to take risk. One of the worst things you can do with investing is pulling your money out when you see a decline. You're essentially buying high and selling low, which is the absolute opposite of what you want to do in investing. The only guarantee with investing is that there will be ups and downs. In fact, 30% of the years that we invest are expected to be negative or down years, but the remaining 70% are expected to, get you growth. They're expected to be years where you see positive returns. We can't control a lot of what goes on out there, like whether or not the market actually does well. So we really need to work with this reality and set our portfolios up appropriately. As individual investors, we do have a couple of edges, essentially things that we can control that'll help us be successful over the long term. At Wealthsimple, we have these 5 simple rules that focus on the things that we can control that can help us become successful when investing for our long-term goals. Rule number 1 is to just get started. At Wealthsimple, we like to say that the best day to start investing was yesterday, but the second best day is today. By starting early, you can take advantage of compounding returns like we discussed earlier. So going back to the snowball effect, the more time we give our money to make money, so the longer that snowball has to roll down the hill, the bigger it'll get by the time that it gets to the bottom. So by getting started earlier, you have the chance of having a bigger kind of pot of money by the time you reach your goal. Number 2 is don't pick stocks. So when picking individual stocks to invest in, you're at risk of putting all your eggs in one basket. So all your money is dependent on how that specific business does, which unfortunately no one can really predict. So it's really important to diversify your investments. So we can take a look at a particular stock that everyone thought was a really great investment back in the day, which is BlackBerry stock. So if we look at all time, around this time, a lot of people thought BlackBerry was a really great investment. Prices and its value was just going up and up, but it eventually did peak. So if, let's say, you decided that BlackBerry is a good place to put your money, it's going to grow forever, they're doing amazing, and you put all your retirement savings in here, you might have felt really smart here at the top, but over here you've lost all your retirement savings. So in that sense, it can be a really risky move. Everyone had really high hopes really high hopes for BlackBerry, but when you choose to invest in a specific company, there are so many risks risk factors that could affect them. So let's say a change in management, improvements in technology, competition from other companies. These things can affect a company and they aren't predictable. So this really just brings us to our 3rd rule, which is diversification. Diversifying allows us to reduce our risk while still optimizing returns. So essentially making sure that we're not putting our money all in one place, but rather investing in many different stocks, across many different sectors and industries, many different regions, so that we're not dependent on a single company, a single sector, or a single country to do well for us to reach our goals. ETFs are a really great form of diversification. If you're not familiar, ETFs are exchange traded funds. By using one ETF, you can essentially purchase shares of thousands of companies for a really affordable price. So one ETF will, for example, track a specific market. So you can have an ETF that tracks the US market, and within that ETF will be fractional shares of thousands of different US companies. So you're getting exposure to all those companies, you're spreading your eggs across many different baskets, and you're not dependent on how a single one does. And you're able to get exposure to how the whole US market is performing by buying that single ETF. If you have ETFs that track different markets, so US, Canada, international markets, you're getting global exposure. So you're not only diversifying across the country, you're also diversifying across the world. Rule number 4 is to keep your costs low. So this is talking about the fees that you're paying for your investments. There's absolutely nothing wrong with paying for a service, but you need to make sure you're getting value for that service. So just like compound interest can help your investments grow over time, fees will really eat into your returns over time. In Canada, we pay the highest investment costs in the developed world. The average management fee is 2.35% in Canada, and it's around 0.8% in the US. So we're paying a lot more than our neighbors are just to invest. If you're already invested in a mutual fund, for example, and you're not too sure what you're paying in fees, I would highly recommend doing some research. A website that we like to use is Morningstar, and it's really useful to check your fees. So I'll show you an example here. So if you actually just Google the code for your mutual fund, or the name of your mutual fund, which you can find on your statement, and with Morningstar, it'll take you to the right page. So let's say, for example, we're invested in RBC Balanced Fund A. Over here, I can see my MER. So that's 2.16% that I'm paying to be invested in this mutual fund. ETFs tend to be much cheaper with MERs of around 0.2%. So you can see that by paying that higher fee for not necessarily a better investment, that will eat into your returns over time. And we actually have another really helpful tool to help you understand that. So let's say you're starting with $100, you're putting in $10 every year, and you expect to make 5% on this investment. And now the difference in just the fee that you're paying makes a difference in how much you earn in the end. So let's say we're paying 0.5% for this first investment, but for the second one, it has a fee closer to 2%, like the mutual fund that we just saw. Over the same investment term, we're paying around $8 in fees here, and we're paying over 4 times more here, so $35.47. Your lost earnings due to this are much greater when you're paying a higher fee. So when you are using an investment service, make sure you know exactly what you're paying, and that what you're paying is actually worth the service that you're getting.
Jess, sorry, this is Tommy. What was that website you just showed us?
So the website, it's savvyfinancial.com, and I'll share all of these links with you after for you to share with the group as well.
Awesome, thank you.
No worries. Awesome. So finally, rule number 5 is to tune out the noise. The news is made to keep us all watching. So there'll be flashy headlines that tell us everything's going to crash, or recession is coming, and those are there to really get the views. You will see experts on the news saying, half say one thing, half say the other. They're all making predictions about what's going to happen next. But the truth is, no one knows what's going to happen in the short term. It's really important to create a plan based on your long-term goals that you can stick to through good times and bad. So like we mentioned earlier with the risk cheat sheet, making sure that if I have 5 to 10 years, I am taking that a portfolio with a medium risk, and even if I see markets crashing, I keep my time horizon in mind, and I stick to my medium risk portfolio. So that'll serve me well when markets are doing really well, and it should be what I stick to even when markets are not doing well. the thing is that the economy will go up in the long term. So despite the major downturns we've seen in the past, that we've seen recently, economies always bounce back. And you can believe this to be true as long as you believe that humans will keep on building and buying things into the future. And this comes back to our money mindset. We want to avoid veering off the plan that we put into place in calmer times. So it's really important that when you do create an investment plan, it's at a time that you're not feeling too emotional, and you should really be in a calm place when you are setting up that plan, so that when things do get hard, it's really hard to see markets, all moving all over the place, seeing, it might be a tough time, especially when things are tough in the economy. They may be tough personally as well, but it's important to stick to the plan that you made when things were calmer. You should revisit that plan to make sure that you're still on track in case of a major life event or a change in your personal circumstances. So that's when you should go back to see your investments or to see your full financial plan and see if you're still on track given that major change. But don't make changes to your plan based on just something that you see in the news or something that your neighbor tells you if nothing's changed personally. Markets are expected to go down just the way that they're expected to go up. And when you're creating your plan, that volatility should be taken into account from the start. So rule number 5, it's really important to tune out the noise and stick to your plan. Awesome. Anyone have questions at this point?
Guys, this is a good time to ask any of those burning questions you've been having about investments, financial planning.
You can also email us if you'd prefer to reach us directly. Our emails are on the screen here. And if you would like to discuss your personal financial situation further, I'd also be happy to jump on a call. We'll share a link to book a call with our team. So if you would like to discuss, or if you have any questions about Wealthsimple, definitely do book. But other than that, we've also included a sign-up bonus for anyone who's not a client yet. This would get you $10,000 in assets managed for free. So you essentially wouldn't be charged on the first $10,000 you deposit into your Wealthsimple account for the first 12 months.
Anyone have any questions about anything we touched on, like at the beginning of the presentation? Happy to address those as well. Or even a comment, doesn't necessarily have to be questions, thoughts. I know money can be definitely an intimidating subject, but the more we talk about it, the easier it becomes to handle.
Okay, so we got 2 here. First one is, how do I buy stocks? I'm a beginner.
Yeah, I can take that. So essentially, you can buy stocks through various platforms. Wealthsimple has specifically a stock trading platform as well. There's Questrade that has stock trading platforms. Kind of the tips and tricks to buying stocks. Again, going back to Shez's point, we don't ever recommend buying like single stocks because it's so very hard to know whether a particular stock is going to be doing well or not. So it's always preferable to hold a basket of ETFs or a basket of stocks and have it well diversified. But let's say in the event that you want to buy a particular stock because you really believe in the company, the first thing to do is just compare and contrast various platforms, in particular what fees they charge in order for you to make a particular trade. This could be fees that are on like a per trade basis or just a fee to open the account. So just kind of doing your research based on that, as well as going back to the knowing what type of account you want to have that stock in is also very important, because you'll be charged differently in terms of taxes depending on where you hold that stock. So those are kind of the 2 places to begin. And if you also like, in terms of, I can only speak for Wealthsimple, but we do have a great trade help center that if you did have any questions, kind of like the one you had on how to get started, it answers much of those questions there as well. So I hope that kind of covered the basis of your question, Hannah. So the second question is, can you talk more on the cash account? Yeah, I'll definitely grab that one as well. Yeah, so the cash account at Wealthsimple is basically what we call a hybrid account. It's for spending and savings. Right now, it's only the savings features that are available, meaning that any money you put into this cash account sits purely in cash, hence the name, but it does earn interest. Right now, it's at 0.9%. So as long as your money stays there, you're earning that 0.9% in interest. Soon, likely by the end of summer, is when we're going to be releasing the spending features, and that includes the card. If you've heard about that card, it's going to be a black metal card that if you're interested, you can sign up for that, and you'll be able to use that card pretty much to make purchases essentially at any kind of POS terminals. POS meaning purchase of sales terminals, as well as do like money transfers, as well as use it to pay bills and things like that. All of those features are kind of set to come out at the end of summer. And the next question is, I might have to go, so questions after I get the slide and go through it and
so she's just saying that she'll probably have questions after she goes through the slides.
Oh, gotcha. Okay. Yeah, no, not a problem. Like Shrez was saying, like, feel free to definitely utilize those two email addresses. Shoot us any kind of emails. Yeah, happy to answer.
Yeah. Just, I wanted to ask something, and I hope it's relevant for other people. What's a good way to know what your investment risk appetite is? Are there things that you can do to gauge? Because if you're new to investing, you might not know if you're aggressive versus medium versus low. How would you recommend someone finding that out?
So, I mean, when you get set up with an investment service, so like Wealthsimple, we would take you through a questionnaire essentially that asks you a couple of questions about what your goals are, as well as your tolerance for risk. So you'll get asked a question like, would you be comfortable losing $500 if it means that you're going to earn $600 in the long term? Something like that. That'll help us understand what your tolerance is for risk. So if you are comfortable losing money, if it means that you're going to make a significant amount of money in the long term, then you probably have a high risk appetite. I mean, one thing that I also discuss with my clients is, let's say if they are investing for retirement, they've got 10, 15 plus years till they need that money, we would discuss, let's say, a high risk growth portfolio. And to give you an idea of the risk, a growth portfolio would be expected to decline by around 40% as we go through a downturn scenario. So that's almost half your account gone, but it would be expected to recover around 3 to 4 years later. So if you're able to, stick to your plan through those 4 years of negative returns, knowing that in 10, 15 years, you're going to be making at least 6 to 7% per year, then we would feel comfortable placing you in that high risk portfolio. So that might have been a lot of information at once. So let me know if any of you have questions. But if you are unsure of your risk tolerance, definitely get in touch, book a call with myself or a member of the Wealthsimple team, and we'd be happy to help you understand what your tolerance for risk is. The reality is, though, that a lot of people don't really know what their tolerance for risk is until they've felt those losses. Before coronavirus, we actually had one of the longest stretches of good returns that we've had in history. I think we had like 15 years straight of really good returns in the market, and then all of a sudden we saw a crash. So Um, so a lot of people felt that they would be suitable for something high growth because markets were doing really well. But then as soon as they saw that crash, they realized that, you know, maybe I'm not comfortable losing my money. Maybe I do need to dial back my risks. So that it is a hard lesson to learn sometimes.
Definitely. I'll share my like a little personal story because I have some investments, and as soon as the market started to like take a turn for like in the opposite or wrong direction, I was like, don't look at your portfolio. Like, don't look at it. Don't go in. Don't check it out. Because once you start to see the numbers go down, you start to panic a little bit. So I think for about 2 months, I did not look at it at all. Because normally I'm checking when I get statements and whatnot. But for those 2 months, I was just like, no. And then I started paying attention to the news and saying, okay, it looks like it's starting to level out a little bit. And then I got a little okay with checking it again. But I just didn't look at it.
I absolutely agree there. I mean, for just giving my own example, my investments are mostly for the long term, for retirement. So I know I'm not going to be touching that money for a very long time. And during this time, I knew it would be stressful for me. I'm a fairly risk averse person. So I knew that if I saw those losses, I might get a little bit emotional. But so I looked at my account once. And ever since March, I've seen it once, and that's it.
Yeah, just to share the experience, I was on the other end because mine was pretty risky because I was like, oh, I know risk, I can take it, and I saw the numbers and the negatives, and I was like, my God, I was like, so glad I didn't put all of it in there. But I totally agree with you. I think part of it is like, even when you think you know, you should really check and test it out, because until you feel that in your gut and you're like, oh, that's a couple of $1,000. Okay, interesting, right? It's different. But yeah, the tools are definitely helpful to kind of get you thinking about it and really, like you said, kind of feeling it and noticing what it's like. But I think that's one of the interesting things around Corona, right? Because it's showing us things that we have to pay attention to. And I think that's why we were saying, everybody on the call, you know, really it's a good opportunity to ask these lovely lady questions, because it's not really every day you get a chance to have some, you know, kind of one-on-one time. And so just going to encourage you again to take advantage of it and ask a few things, because I know that we've benefited quite a bit from the feedback. So just going to open it up and say, you know, don't be shy, ask questions. It's a very safe space.
I think one conversation that I have with really new investors, I feel like young people feel that they need to be high risk just because, you know, they're young. Like, it's okay to be risky when you're young. It's not like you have kids or dependents or anyone else to worry about. So might as well like go hard or go home. But if you don't know what what volatility really feels like, I would suggest starting with something, you know, more balanced, or more of a medium risk level. See how you feel, see how you react to volatility, and if you don't really, it doesn't affect you, then definitely bump up that risk and take advantage of good returns while you're investing. But if you find that it makes you a little weary, then being in something balanced is definitely a better option.
And for those who are wondering, Wealthsimple, there's no minimum that you have to put into the account to start investing. Just FYI, because I know some, depending on some wealth management firms, you do have like a minimum that you have to put in to start investing. But I think Wealthsimple and a few other um, platforms like that, there's no minimum. You can start with $5 if you want to start with $5.
Exactly. You're exactly right. So if you do want to just test out the platform, you can put in $5. And if you don't like it, you can take it out, and there's no fee for that either. But you can start with as little as $5.
Doesn't look like we're having any other questions. Um, scrolling there. Yeah. I was trying to think of if I had any other questions as well, but you guys were very, very thorough. So thank you for that.
Awesome. I mean, we'll share the links for all the resources that we showed today. We'll share the investing masterclass videos. It's a whole series. I believe it's 10 or so videos on different topics within investing that are they're really fun to watch, honestly. I might be a little bit biased, but I enjoyed them. But so if you are interested, definitely recommend kind of taking a look through those, and we'll share those all after.
Awesome. Okay, so I will be the judge and say we can end here for today. And anyone who has questions for Shez or Sadia, we'll share the recording, and I think you guys will be giving us slides as well to share with everyone, just so you guys have that information and whatever links that they provide as well. So thank you everyone for attending. I hope you got some important information and valuable information from this. And a big thank you to Shez and Sadia.
Thanks so much for hosting.
Thanks, everybody.
Have a good, oh, wait, what? Oh, yes, so she just said. All right, have a good night, everyone. Bye.
Good night.
See you guys.
Bye.
Bye.